Hello and welcome to the How to Exit podcast. Today I'm here with Scott Duke. He's the founder of Open Road, which is a middle market M&A service company out of Canada. Thank you for being on the show today, Scott.
Hey, Ron, thanks for having me. It's much appreciated.
Talk about what is the differences real quick because you're in Canada. Do you service businesses in the Canada and the United States and other places? Are you primarily Canada brokerage or
Yeah, we're primarily Canada, about 90% of our business. We'll do some work in the US. Do have a fair bit of US buyers that are shifting some money into Canada just from a diversification standpoint. Mhm.
cool?
Mhm.
And what type of companies do you get to work with? I mean, they're not all ski resorts. You're dealing with a full range of companies.
We don't do a lot of work in the town that I live in just because our primary market that we work with from a size perspective is 2 million to 20 million in revenue. That's kind of our
Okay.
sweet spot that our team works on. I guess that's our kind of our main category of how we decide. And then from there, we have certain industries that we work with. So we have about 36 industries that we specifically work with, a lot of service-based companies. So B2B service. Yeah, I mean, first people when it's so I found 11 companies, fine, but these aren't monsters. The reality is this is how most entrepreneurs get into the space is you start something small. Like this is how it goes. And my story is similar to most is that you're in university, you need to find a way to pay for school, you don't want to take on a lot of student debt, so you go out and figure out a way to start a company. I don't know, some people do that. I did that. And I started a painting company. So people use College Pro and that kind of stuff. My brain works a little bit different, I suppose. I'm not the franchise guy and I want to have a little bit of control over the companies that I operate. So when we started this painting company when I was in university, our niche that we went into was servicing cottages. I bought a boat and that way we could charge almost double on our hourly rate because we could service cottages that were on islands and no one else could get to them. So no one else was servicing them. So that's what I did through my entire university, which was lucrative. And then I did have a stint where I lasted 3 weeks working in corporate and just making less than I made with my painting company. I knew I didn't want to be a painter forever, but I knew that running companies was a little bit more lucrative than what I was doing at the time. So that was kind of the first real company that I started. I had a small business in university where we made fleece apparel, or in high school, sorry. Anyway, and then after that, we built the largest, when I say we, you always have people that are working with you and you always have a team that does stuff, but we built the largest wakeboard facility in North America. So for those people that know what that is, it's kind of essentially a water ski facility. But we did that in Canada. That didn't sell, so that shut down, and that's really what started me down the path into this M&A was figuring out, okay, if I just put 5 years of my life into building this pretty impressive company.
What was I should just help other people do this right. What was the
Yep.
deciding factor that made you go into the advisory role?
Pain. Like that's it. The pain was the biggest thing. If you build something fantastic, or even if your mind you think it's fantastic, and then you watch it wither on the vine and die, that's a painful thing. And I just want other entrepreneurs to honestly avoid that one. Maybe we have to all learn these lessons the hard way. I don't really know, but it sure is like mistakes were made, but not by me is maybe the better way to go about it. And I think that a lot of us choose or end up on our paths and our journey because we've gone through some kind of pain in our life, figured out how to solve it because of that. And then we feel that we need to give back to make sure other people don't kind of step in that pothole. That's certainly, without question, my story. And as having talked to countless entrepreneurs and people in this space, when we build businesses, they end up being part of our identity. And when a chunk of your identity dies, it's a tough one mentally to get through too. Like it's not easy. And even like the entrepreneurs that we deal with and business owners that we work with that are in their 60s, in their 70s, like my oldest client right now is 76, that are looking to exit at that point because of retirement, their companies are more of their identity than anybody because they've been running these for 30, 40 years, that kind of thing. Part of the difficult part of transition is really just kind of decoupling yourself from your business. And if you can do that over a slower period of time, you can plan for that. It makes it a heck of a lot easier than it being kind of ripped away because you don't have a sellable asset and it just ends up shutting down. That's definitely why I'm on my path. And as far as the biggest lesson that I learned from that was, okay, if I'm going to build more businesses throughout my career, then I sure as, like I said earlier, I sure as heck better learn how to make them transferable if I want to exit. But the biggest lesson was just owner dependence. If you don't know your culture, maybe don't get into acquisition quite yet. Like refine what that culture is in your own business before you go and try and acquire another one. Because if your culture is different, you're going to lose those people. And if you don't know what your culture is, you can't see if there's a match. So I would say that's important. And then the other thing that I'll say to my clients when they buy is what you really need to do, what the employees are looking for is to ensure that their job's secure. And everyone has this idea that when a business acquires another business, they're going to go lay off all the people. That's not the case. Like there is some redundancy, right? You don't need two accounting departments. So you may be able to get rid of some people from a finance perspective. You don't need two HR departments for the most part. These kind of sides of a business, there may be overlap in those jobs may be redundant. But for the most part, the people are trying to they're acquiring the business, are trying to retain the staff. That's their objective. Anyhow, what you want to know is you want to know, what is it? Keep things the same as much as you possibly can. Like, let people know they have security, their job's not going anywhere, nothing's going to change. That's really what people are most nervous about, is change. So ensure that they know that that's not going to happen. Nearing to the end of the deal, if not after the deal's been signed and completely inked, but nearing to the end, when everyone has confidence, buyer has confidence, seller has confidence, that there's like a 95% chance this deal's going through, then communication can start happening with the team, right? And it can happen at different levels. So people that are your executive or the ones that you're working closely with, they're going to find it maybe a little bit sooner. But they need to, and this is what I suggest to my sellers and what I say to the sellers, is that when the bulk of the employees, call it 90%, when they learn about it that day, that is the same day that they need to be introduced to the buyer. And that is the same day that the handoff needs to happen. And they need to learn that this buyer is a good buyer and it's a good person to carry them forward and their careers forward. What you don't want is, you don't want to say, hey, we're selling the company and there's these great buyers that are purchasing the company, and the employees don't get to meet the buyer for like a week and a half or something, because that gap, and just talking about communication, that gap just breeds fear and uncertainty. So you want to tell them the news, and then immediately it's like, here's the new buyer, and they're going to be great, and they take it from there. So that's the way that I suggest it gets handled, and that's kind of the timing of when it should be handled. Yeah, family offices usually have their own capital they're deploying. The private
Right.
equity firms are going out and they're getting investors to then create a fund to then go and deploy that fund. Fundamentally, they look the same as far as what they're looking to acquire. They're looking to acquire businesses that have reduced the riskiness of their company, that when an outside investor buys it, it can still continue to scale. And scale may be the wrong word, because a lot of these individuals are just looking to grow. Like,
Mhm.
scale is more of a tech thing where it's like, all right, we're going to take it from 0 to 100, where for the most part, people that are in the acquisition space are really just looking to take it from like 2 to 3. Like, that's kind of what they're trying to do, like stage 2 to stage 3, right? So anyway, but they're looking for the same stuff. They're looking to make sure that this business has at least at a certain amount gotten rid of the owner dependence. So there's maybe a general manager that's in that business that can continue to operate on a go forward basis after the owners maybe worked for a year, 2 years to transition. And they're looking to make sure there's no specific risk that's in that business that's going to be cataclysmic. Is there customer concentration issues that are going to, you lose that one customer in the business? I had a call with a guy yesterday that was looking to buy a company. 95% of the business is one customer. Like, you lose that customer, you don't have a company anymore. So they're certainly looking to that. They're looking into key employee dependence. They're looking into the software and how it's set up from if they can actually grow moving forward with that software, because the processes are set up in the business. So these are the kind of things that they're looking into. Our customers on contracts. We have another business they're working with right now. And the vast majority of their customers weren't on contracts. So to get the business across the finish line, everybody's got to get on contracts, right? So has this work been done essentially? And that is still the case, even with people that are going to retire. They go, oh, yeah, I know what I'm doing next. I'm retiring. It's like, what does retirement actually look like? If they haven't thought through that, the entrepreneur that I like the best, is most secure for guys in my position that are looking to actually transact a company, is the entrepreneur that knows the next business that they're starting, or has already got it started and is now the pain point of their old business is slowing their new business growth down.
Right.
They know exactly what they're doing because they've already got the next machine going. But if, yeah, I couldn't agree more. If people don't know what they're doing next, it's very difficult to sell.